This is On the Money with financial advisor Ryan Wheelis and the founder of Allied Wealth, offices all around Houston. I'm your host, Spike Spangle. For those of you who are listening on the radio program, as Ryan was saying, I'm really interested in this, and I'm wondering how it became this way and what you do at your firm's practice. Mutual funds and exchange-traded funds. Now, the mutual fund industry, they're the big kid on the block, right? There's trillions of dollars. But we have been noticing, and so have all of the different reporting firms, that more and more mutual funds have been fading away, and it's flowing into exchange-traded funds. This opens up a big conversation. And you know me, I've got like 9 questions. Why is this happening? Is this a good thing? Is it sustainable? How did so much money get into mutual funds in the first place? Hit me, big guy.
Oh, gosh, dang, Spike, that's a lot. Well, mutual funds were kind of like back in the day, this thing, right? So you could go down to maybe saved up $20,000, for instance, all right? And you go down to a retail strip center or a bank and walk at the door and say, hey, advisor, I want to buy some stocks. And the advisor says, well, what do you know about picking stocks? He says, I don't know much. He says, I got a better idea. We got this thing called a mutual fund, all right, where you mutually share ownership in this fund with other investors around the country. And what happens is we put you in this fund. You get a professional money manager, all right, and this money manager buys and sells stocks for you, okay? So you also get diversification. Cool, right? Because, you've got kind of this program, this manager's out there working on your behalf to get good returns, that sort of thing, and you get diversification. And that's kind of what happened, and that's where the advent of the fund was. Forward to 1978 when they added the 401k plan, which most of us have, by the way, or 3B, 401A. There's a lot of different ones out there, 457. But nonetheless, these are plans, okay? And so these plans have money flowing then into them, company matches going into them as well, right? But the ultimate investment vehicle inside of 401k plans today are mutual funds. So you go from 1978 to the year 2000, the market melted up big time because all of this money was flowing into these mutual funds. And I believe that the money pouring into 401k plans, company match on top of those dollars, growth in the market during that period, which is about a 1,200% return, by the way, all right, that's what caused this massive expansion of mutual funds, all right? But what's interesting, most times when someone leaves a company to retire, they're going to roll their 401k money over. He's going to leave the 401k plan most times in the form of a check, okay, paid to the next institution. So if you're going from your 401k plan, you might be going to Charles Schwab, could be going to Fidelity. There's some other custodians out there as well. Apex is another one, but they're custodians, right? And your money goes over to this new custodian. Advisors today, whether they manage money in-house like we do at Allied Wealth, or they leverage a third-party money manager in the relationship, most advisors today are using modern-day mutual funds called ETFs, exchange-traded funds. And folks, the reason why that's happening is, in exchange-traded fund, the costs and expenses are so much lower than they are in a mutual fund, all right? And that's important because returns are directly impacted by fees. So if you're paying a 1.5% fee in a mutual fund over a 30-year period on $1 million portfolio, that's some big money. We're talking $400,000 a year-ish on a 30-year retirement. We can lower that fee substantially by using an ETF down to about 20 or 30 basis points. So substantial cost savings, okay? Next thing that happens, Spike, is you have an ETF. The ETF stands for Exchange Traded Fund. Now, that's really important because a mutual fund is a mutual fund, and there's a mutual fund company that runs the fund. And you want to sell your shares of that mutual fund, you have to sell them back to the actual mutual fund company, okay? You want to sell your shares of an exchange-traded fund, those shares are traded over a stock exchange, so New York Stock Exchange, like shares of stock. So instead of selling my shares back to a mutual fund company, I could sell my shares to Spike and sell his shares to me. That's important because if you want to have intraday market performance and liquidity, ETF does that. A mutual fund doesn't. Another important aspect, Spike, probably the most important one. Mutual fund managers are subject to regulations. And we're all subject to regulations, but this particular regulation is super important to know, and it's called Regulation 35D1. It dictates what a mutual fund manager can do with the funds in the mutual fund, with the money in the fund. All right. So basically, what happens is this: the mutual fund manager calls themselves a technology fund. In the Reg 35D1, they have to keep 80% of the fund's money invested in tech stocks 100% of the time. It's in the money invested all the time. All right. So if they see the market crash coming at them, all they can do is raise a 20% cash position in the fund, because the law says the remaining 80% of the money in the fund has to be invested at all times in tech stocks. All right. So what happens is people think that this fund manager is moving stuff around in a way to mitigate downside risk in a falling stock market. All right. But the reality is they're not, because they can't, because there's regulation.
Okay.
Right? This is just one example of the education folks need, Spike.
Yeah. Yeah. Now, man, you gave me a lot. So I usually hit you with a lot of questions. Let's go back and circle on to the costs. If our 401ks and our 403bs and all of the different retirement funds and accounts that we're using are using mutual funds, aren't those costs hurting us, the person who's saved? Do we have any say of what goes into our 401ks, or do we need to call our 401k providers and say, hey, are you starting to use exchange-traded funds? I understand they're less expensive.
The interesting thing about the 401k plan and the mutual funds inside of a 401k plan, a lot of times the funds are heavily discounted, all right? And that's because of laws related to ERISA and that sort of thing. But a lot of them are discounted. It's when you move out of the 401k into an IRA, the advisor you're working with is recommending mutual funds. I highly suggest you check out what the fees are, all right? There's also, once you get outside the 401k plan, also substantial commissions that can be paid. Anytime a commission is paid, there's nothing wrong with somebody earning a living, okay? But anytime a commission is paid, only 100 pennies in every dollar. All right. So if a 5% commission is paid, somebody got that money, and now there's 95 cents on those dollars left to perform for you. Now, over time, that commission grows back, but just watch out for that, right? The fees and commissions can greatly erode your returns over time. And to my knowledge, ETFs do not pay commissions, okay? They're also cheaper. You can also get actively managed ETFs as well. And it's about, in every way, I think an ETF is a much better option than a mutual fund for just many more reasons than we've discussed.
Can you tell me then at Allied Wealth, and as you were talking about earlier in the program, you've got even different tiers of people's wealth. Are you able to shift people then from that version of 401k that had an expensive mutual fund, mirror, or even maybe do something less expensive in your own version? Tell me a little bit about the management of what you do at On the Money.
Mike, it's pretty rare that I've met someone that I can't cut their management and investment fees in half. Pretty rare instance, by the way, okay? So substantial savings. We use programs that have no fees whatsoever on them, by the way. Programs that have fees on them, okay? One of our growth stock portfolios has a 1.65% fee. It's not negotiable. But if I showed you the performance of this portfolio, you'd be like, that's probably worth the 1.65% fee, because we say if they're only an issue in the absence of value, right? So the thing is we have to look and see what the costs associated are, but working in a way to create a situation where you're paying the minimum amount of fees possible to get the best returns you can with the least amount of downside drawdown risk or loss potential in a down market. And that's important, Spike, because folks don't necessarily need great returns to make their money last a lifetime of their golden years. What they have to do, though, is they got to avoid great losses. As an example, all right? If you have a portfolio where it's, the market's up 50, down 50, up 30, okay? The average return there is 10%, but your portfolio is still down $5,000. So you've got a 10% average annual return and you're down $5,000. How does that work, right? More importantly, if you go up 50% and you go down 50%, your average return is zero. You go down 50%, then up 50%, your average return is zero, but your portfolio value on a $100,000 investment is $75,000. Mitigating fees Everybody of mine calls them as financial termites, is super important. All right.
Yeah.
And navigating those closely is super important, but also mitigating downside risk and maximizing performance is equally important. And so somewhere all three of those lines cross, and how to do that for our clients, Allied Wealth, with the least amount of risk, most amount of return, and the least amount of fees possible.
Thank you so very much. Unfortunately, for our radio listeners, we got to take a very short break right now, but you can get your own review on your costs inside your investments just by dialing the phone number 844-944-7555. That's 844-944-7555, or you can go right to our landing page, retirenowhouston.com. That's retirenowhouston.com. More with Ryan Wheelis right after this.